Marvell Technology, NASDAQ, Mrvl, currently trades at approximately 62.87, representing a significant downturn of over 18% in intraday trading following its recent earnings report. This precipitous drop places the stock well into the lower half of its 52-week range of 47.09 to 127.48, a stark contrast to the once unbridled optimism that characterized its ascent earlier in the year. The immediate, knee-jerk reaction of the market is one of profound disappointment, driven by a forward guidance that, while positive, did not meet the impossibly high expectations baked into the stock's valuation. Investors who were anticipating another explosive NVIDIA-esque forecast for AI-driven growth were instead confronted with a more sober, tempered outlook. This is the tension at the heart of the Marvell story. The conflict between a company that is executing a deeply successful strategic transformation and a market that is demanding a near-flawless, hyper-accelerated timeline for that transformation to materialize. The common narrative is that Marvell's guidance disappointed on AI, and that this signals a potential slowdown in the custom silicon and data center boom. But this surface-level analysis misses the critical, underlying reality. The disappointment isn't a failure of Marvell's strategy, but rather a recalibration of the market's own unrealistic expectations. The company actually delivered record revenue of just over $2 billion, a staggering 58% year-over-year increase, with non-GAAP earnings per share perfectly in line with analyst consensus. The data center segment, the true engine of Marvell's growth, saw a 69% year-over-year revenue surge. The fact that a company can deliver a record-breaking quarter, meet consensus estimates, and still see its stock price collapse by double digits reveals the true psychology at play. This isn't about underperformance. It's about the market's inability to digest anything less than stratospheric, compounded growth in the AI sector. The real story is what's happening beneath this turbulent surface, where Marvell is systematically building a foundational, durable business in the most critical segments of the modern digital economy. The central pillar of Marvell's narrative is its strategic pivot away from a more generalized portfolio to an exclusive focus on data infrastructure. This is not a trivial repositioning. It is a profound and deliberate shift that began with key divestitures, most notably the sale of its automotive Ethernet business. The company has essentially declared that its future is singularly tethered to the explosive growth of data centers, AI, and cloud computing. The application of this strategy is evident in its segment revenue mix, where the data center business now accounts for the vast majority of total revenue. This is a massive leap from just a few years ago. But the real insight lies in the type of growth this segment is experiencing. It's not simply a rising tide lifting all boats. It's a specific, high-margin, and defensible growth driver rooted in custom silicon. Marvell is not just selling commodity chips. It's co-developing bespoke application-specific integrated circuits, ASICs, with the world's largest hyperscalers and cloud providers like Amazon Web Services and Microsoft Azure. This design win model means that Marvell is embedding itself deeply within its customers' ecosystems, creating long-term, multi-generational revenue streams. The company has stated it is engaged in over 50 new design opportunities with more than 10 customers, a pipeline with a lifetime revenue potential in the tens of billions of dollars. This isn't a speculative play. It's a strategic beachhead in the core of the AI revolution, and it's a far more powerful and lasting moat than the market's fixation on short-term guidance might suggest. The importance of this cannot be overstated. While consumer-facing chip makers like AMD and NVIDIA get the headlines for their GPUs, the real dirty work of AI and cloud computing is done by the networking, security, and storage infrastructure that Marvell specializes in. They are the architects of the plumbing that makes the data flow, and their custom solutions are a critical, non-negotiable component of a hyperscaler's infrastructure build-out. Furthermore, the macro-level context provides a vital counterpoint to the market's near-term panic. The shift to a more sober guidance is not just a Marvell-specific event. It is indicative of a broader, more mature phase of the AI infrastructure build-out. The initial frantic phase of stockpiling and high-velocity purchasing by hyperscalers is giving way to a more measured, methodical deployment cycle. Hyperscalers are now focused on optimizing their AI clusters, which involves more than just buying the latest GPU. It requires a complete system-level overhaul, where networking, interconnects, and custom silicon become paramount. This is precisely where Marvell's competitive advantage lies. While the market may have been expecting a straight vertical line of growth, The reality is a more complex, undulating ramp-up that involves deep engineering collaborations and multi-year roadmaps. Marvell's management team, in its recent commentary, highlighted that some of these large-scale custom AI chip ramp-ups are simply taking more time to fully materialize. This isn't a sign of demand weakness. It's a reflection of the sheer scale and complexity of these projects. The fact that the stock is being punished for this measured, professional approach highlights a market dynamic where patience has become a scarce commodity. Meanwhile, Marvell's non-data center businesses, such as enterprise networking and carrier infrastructure, are beginning to show signs of a cyclical recovery. This diversification, while a smaller part of the revenue pie, provides a crucial layer of resilience and a potential upside catalyst that the market is currently ignoring in its singular focus on the AI segment. The balance sheet also remains solid, with strong cash flow from operations, which gives the company the financial flexibility to continue investing heavily in R&D, maintaining its technological edge over competitors. The deeper analysis reveals a company that is building a robust, multifaceted business designed to capture value across the entire data infrastructure stack, not just in one fleeting segment. The common belief is that Marvell is simply an AI play, a beta version of a more established titan like NVIDIA. But the reality is far more complex and compelling. Marvell's expertise extends across custom ASICs, Ethernet solutions, and a burgeoning electro-optics business, all of which are essential for enabling high-speed, secure, and efficient data movement. The company's recent collaboration with Microsoft Azure to integrate its liquid security solutions is a perfect example of this. This isn't just about selling a chip. It's about providing a system-level solution that solves a critical pain point for a major cloud provider. This kind of deep architectural integration creates significant barriers to entry for competitors. The competitive landscape, which includes giants like Broadcom and smaller nimble players like Astera Labs, is incredibly fierce. However, Marvell has carved out a unique position by leveraging its intellectual property and systems engineering expertise to address highly specific and demanding customer requirements. The fact that they are now engaged in over 50 new AI design opportunities is not just a number. It's a signal of their growing mindshare and credibility with the very customers who are defining the future of AI. The market's current disappointment over near-term guidance misses the forest for the trees. The long-term narrative for Marvell is not about a single quarter's revenue beat or miss, but about the compounding effect of these strategic design wins and their potential to create a high-margin, durable business for years to come. This is the difference between being a participant in a growth trend and being a foundational enabler of that trend. Marvell is firmly in the latter category. The recent sell-off, while painful, may simply represent the emotional market correcting its own overzealous projections, offering a more attractive entry point for investors who can see beyond the immediate headline and recognize the deep, strategic value being created. The shift in investor focus from a pure growth narrative to one that demands immediate, flawless execution, even in the face of record-breaking performance, is a powerful reminder of the irrationality that can grip the market. But for those with a longer time horizon, the fundamental reality of Marvell's positioning remains compelling. In conclusion, the market's expectation was for Marvell to deliver an otherworldly forecast that would signal a straight, unimpeded path to hypergrowth, a narrative that has become common and often unrealistic in the AI space. The reality, as revealed by the company's recent report and subsequent market reaction, is that Marvell is executing a highly successful, albeit more complex and methodical, strategic transformation. The company delivered record-breaking revenue and met consensus expectations, but its tempered guidance, a reflection of the natural ramp-up cycles of massive infrastructure projects, was interpreted as a sign of weakness. This tension between expectation and reality is the very reason for the stock's recent volatility. The deeper analysis shows that Marvell is not a failing enterprise, but a company that is intelligently and systematically embedding itself at the core of the data infrastructure revolution through a high-margin, defensible business model centered on custom silicon. The focus on long-term design wins with hyperscalers, and the quiet recovery in its legacy businesses paint a picture of a company with a durable growth trajectory. The market's short sight ends,